So Lucy MacDonald of RCM is here to tell us what she expects. She oversees $10 billion as Chief Investment Officer of the group's global equity fund. So she's, in some ways, a great person to talk to about this. Thanks very much for coming in, Lucy. So not a great start to US earnings season with Alcoa, just missing sales estimates.
Yes, and I think we saw the volumes down, prices up, and input costs that they needed to pass through. And that, I think, overall is going to be a quite common theme as we go through the earnings season. Input costs have been on the rise, commodity prices higher, energy prices higher, and in emerging markets we've seen labour costs higher too. So there's quite a lot to be passed on. And then on top of that we also have Japan, which I think we won't get too much of an idea of in this quarter, but as we go in the next few months we'll be able to see the impact that that's had.
And we've got a number of banks reporting this week, along with Google. Tell me about the banks first, your expectations for banks and financial institutions this quarter.
Well, loan growth is still quite weak in the US, although this is traditionally quite a weak quarter. So we need to see that through the rest of the year. The provisions are still coming down, so that's still healthy. But they do look as if they've come to a slightly more a flat stage of their recovery than we've seen over the last couple of years.
Okay, and Google reporting as well. Is tech an attractive industry for you in terms of investment right now?
Technology has been quite challenging in this last quarter within the market. There's quite a lot of structural change going on in technology. As far as the PCs are concerned, the move into tablets, and also down the chain as well, looking at some of the shortages we've got in Japan at the moment. So I think it's going to be quite an interesting one to watch, but quite challenging for investors. So
what are you expecting in general? Tell me about, okay, well, first of all, compare earnings season, US and Europe, because some analysts are saying they're expecting a 20% rise in Stock 600 company earnings for Europe. It's pretty optimistic.
It's not impossible. Overall, the expectations for earnings are about 16% for this year, and that looks just about possible because we have got some top-line growth, and although input costs are coming up and there will be margin pressure in some areas, you have got some operating leverage still coming through. So it looks just about possible. Within Europe, the euro has been stronger in the last quarter, so that's going to be one to deal with. But on balance, I think we should be able to get some decent double-digit return.
And over in the US, you're saying one of the areas that you're focusing on are rising input costs. You also mentioned commodity prices perhaps weighing on company earnings. In general, do you expect more companies to beat analyst estimates this quarter compared to last quarter?
It's going to be harder work this quarter, and as we go through the year, it's going to be harder work for the companies themselves to beat, but also be harder work for the market itself to surprise on the upside, I think.
Does this mean more market volatility?
It probably does, yes. It feels like a bit of a harder grind in the market than it has done over the last couple of years.
Is there a lot of value in the market right now? Is this an environment that you would describe as being favourable?
Valuations in the long term look about neutral, but you can find pockets of value, and there's value in Japan, although there's a lack of visibility on earnings. There's value in some areas of the market of which are the less cyclical areas, because the rise in the market over the last couple of years has been really driven by the cyclicals, so the industrials, materials, and more recently energy. Whereas some of the more stable areas, like consumer staples, healthcare, have been left behind to some, so there's a bit more value there.
Great to get your insight, Lucy MacDonald. Thanks so much for coming in.